When REITs were first launched in the Philippines a few years ago, investors were excited. Finally, we had access to big, income-producing properties, offices, malls, logistics hubs, without having to buy the actual buildings ourselves. And for a while, it worked. The dividends were solid, prices were stable, and it looked like this was the next big wave for passive income investors. But now, reality's kicking in. Prices are down, yields are up not because of growth, but because of weakness. And people are starting to ask, what happened? Let's talk about it. The state of Philippine REITs. Most listed REITs in the Philippines, ARIT, MREIT, RCR, PhilIT, CREIT, have dropped anywhere from 25% to 40% from their peaks. And no, this isn't just market noise. This is a combination of structural issues both inside the property market and in the broader economy. Number 1, vacancies. Office occupancy across Metro Manila, especially in the Bay Area and Ortigas, still hasn't returned to pre-pandemic levels. Back then, the average vacancy rate was around 5 to 7%. Today, in some business districts, it's 15 to 20%, and even higher in areas that relied heavily on Pogos, the Philippine offshore gaming operators. When Pogos pulled out, they left behind entire floors, sometimes entire buildings of empty offices. And many of those spaces still haven't found tenants. That's lost rental income and lower valuations for REIT portfolios. The work from home effect. The second big hit, work from home. The pandemic permanently changed how companies operate. Even if most employees are now back on site or in hybrid setups, office space demand has structurally shifted. Companies realized they don't need as much space as before. One BPO firm that used to occupy 3 floors can now run efficiently on 2. Another has shifted to rotating shifts where desks are shared. This means slower lease renewals, smaller expansions, and pressure on rental rates. So while your REIT may still declare dividends, the growth story, the expectation that rents will rise, that more buildings will be added, is now much harder to sell. Pogos, the ghost tenants. And let's be blunt, the Pogo Pull Out was a massive gut punch. Pogos were the single biggest driver of office demand in the late 2010 seconds. They absorbed space like crazy, paying high rents and filling up entire towers. When they left, they didn't just leave behind empty floors, they left behind a bubble in valuations. Developers priced their assets assuming those tenants would stay for years. But when that collapsed, it exposed how over-dependent the sector was on one volatile tenant base. And many of those same properties were seeded into REITs. So when the anchor tenants disappeared, REIT investors inherited the risk even if they didn't realize it at first. The new threat, AI and BPOs. Now we're facing a new challenge, AI. The business process. Outsourcing sector has been the most stable backbone of office demand since the pandemic. But that's starting to change. With generative AI and automation, many low-level customer service and back-office functions are being replaced or outsourced differently. If that trend accelerates, the BPO industry won't vanish, but it will become leaner. That means slower growth in headcount. And slower headcount growth means slower demand for office space. If you connect the dots, it means potential pressure on REIT revenues in the next few years, not because tenants are defaulting, but because expansion has plateaued. Interest rates and opportunity cost. Now let's zoom out to the macro level. REITs are designed to give investors steady dividend income. That income looks attractive when interest rates are low, but right now interest rates are high. 10-year government bonds in the Philippines are yielding around 6.5 to 7% risk-free. Meanwhile, many REITs are yielding between 6 to 8%. Not bad, but not enough of a premium for the risk you're taking. Think about it. Why buy a REIT with exposure to vacancies, declining rents, and tenant risks if you can earn nearly the same yield in bonds that are guaranteed by the government? That's why funds are rotating out of REITs. And until rates come down or earnings recover, that trend might continue. Currency and foreign capital. Then there's the peso. Foreign investors typically buy REITs for yield and stability. But the peso's weakness, now around 59 to the dollar, what erodes that yield when converted back to stronger currencies. A 7% dividend yield becomes closer to 3% after currency losses. That's why foreign inflows have dried up. Without that institutional demand, REIT prices are left mostly to local investors, many of whom are cautious right now. So, is it still worth buying? Now that we've painted the gloomy picture, here's the real question. Is it still worth buying and holding Philippine REITs? My answer, it depends on your objective and your time horizon. If you're looking for price appreciation, probably not right now. The short-term catalysts just aren't there. We're in a high interest rate, slow growth, high vacancy environment. That's not where REITs outperform. But if you're after steady income and you're patient enough to hold long term, then this is actually when you start watching closely. Because when pessimism peaks, yields rise. And some REITs today are trading below their book value, giving you 7 to 8% yields backed by physical assets. That's not bad. If you can handle the short-term pain. How to be smart about it. So, how should investors play it? First, be selective. Not all REITs are equal. Look at who their tenants are. Look at what types of properties they own. Look at the sponsor's strength, how deep their property pipeline is, and how likely they are to support the REIT. Office-heavy REITs are the most vulnerable right now. But industrial and logistics REITs, or those with exposure to warehousing and data centers, may actually do better as e-commerce and cloud computing expand. Second, reinvest your dividends wisely. If prices remain low, you can use your payouts to buy more shares, compounding your future income. Third, keep an eye on interest rates. The day the central bank starts cutting rates, REITs could rebound hard. Because the moment yields from bonds go down, investors will start chasing higher yielding alternatives again. And when that rotation happens, REITs will be one of the first beneficiaries. Final thoughts. The truth is, REITs were launched in the Philippines at the worst possible time, right before the pandemic and before the global interest rate spike. The timing was unlucky, but the concept itself still makes sense if the country can stabilize, if rates eventually go down, and if the property market adjusts to the new normal of hybrid work, then REITs will find their footing again. But that might take years, not months. So if you're investing today, don't expect a quick rebound. Treat REITs as income instruments, not growth plays. You're paid while you wait, but you'll need patience, discipline, and a realistic view of the risks. Because right now, the office market isn't booming. Pogos aren't coming back. And AI is slowly reshaping the very industry that kept these towers alive. It's not the end of REITs, but it is the end of blind optimism. The smart investors know this. Real estate rewards patience, but only if you buy when everyone else is too scared to. This is stock smarts. Be informed, be strategic, and remember, markets recover, but only for those who understand what they're really buying.